Imagine a company, right? And they somehow managed to grow their revenue by like nearly 22% year over year.
That's pretty solid growth in this
Yeah,
environment.
exactly. It's huge.
Mhm.
And on top of that, they successfully positioned themselves to command what is essentially a Western duopoly in some of the most uh, critical, highly sought-after materials on the planet.
Right.
I mean, materials that completely underpin the future of technology for all of us. So you would naturally assume the market would just reward that kind of strategic dominance, right?
You would think so, yeah.
But if you look at the chart today, this exact same company has watched its stock price just absolutely plummet by 40% in a matter of months.
It completely defies conventional market logic, at least, on the surface.
Right.
Because we have this massive disconnect between the underlying strategic value they're building and the aggressive sell-off that's happening on the open market right now.
Yeah, it's wild.
It is. And to figure out why investors are just running for the exits while the company's fundamentals appear to be getting stronger, we really have to dig into the mechanics of global supply chain warfare.
And that is exactly what we are doing on today's Deep Dive. Welcome in. We are looking at Energy Fuels today, which is a company caught in this really violent tug of war.
Yeah, that's a good way to put it.
You've got booming macroeconomic trends on one side, and then on the other side, just a brutal, unforgiving sector correction.
Right, it's getting hit from both sides.
Exactly. And if you are trying to understand where the critical minerals market is heading over the next decade, this specific situation is essentially a masterclass in the tension between long-term vision and just short-term survival.
For sure. And for you listening, just so you know where we're pulling this from, we've got a stack of recent financial disclosures, technical price action data, market sentiment analyses, and the broader geopolitical context surrounding the sector.
We got a lot to get through.
We do, because the narrative here is incredibly fragile.
Yeah. So to understand this 40% stock collapse, I think we first have to look at the math behind how Energy Fuels actually operates.
Right, because it's highly capital intensive.
Very. But the top-line revenue growth is genuinely robust. I mean, trailing 12-month year-over-year growth is sitting at 21.95%.
Which is no small feat.
No, it's great. It indicates real accelerating demand for what they're pulling out of the ground.
And the initial unit economics reflect that demand too. Like they are operating with a gross margin of 34.58%.
Okay, break that down for us.
Sure. What that means in practical terms is that they can extract raw uranium and rare earth elements, process them, and then sell them for about a third more than the direct cost of getting them out of the dirt.
Which sounds like a really solid foundation.
It is, definitely.
Yeah.
But that grace margin completely masks the reality of the broader enterprise.
Because when we move down the balance sheet to the bottom line, it gets painful.
Very painful. I mean, Energy Fuels is burning cash at a severe rate. They're operating with a negative net margin of 82.7% and an earnings per share of negative 30 cents.
Negative 82.7% net margin. Let's just frame that for a second for everyone.
That's rough.
For every dollar this company brings in, they are losing almost 83 cents once all their operating expenses, corporate overhead, and development costs are factored in.
Exactly.
How does a company with a 34% gross margin bleed that much cash on the back end?
Well, it really comes down to the mechanics of the industry itself. Mining and processing rare earths and uranium, it's not a lightweight software startup.
Right, you can't just pivot in a weekend.
Exactly. You don't just lease an office and write code. You are constructing massive, complex infrastructure.
Heavy machinery,
Yeah.
permits, all of that.
Yeah, you're dealing with intense environmental regulations, permitting delays. The capital expenditures required before you can reach true operational scale are just astronomical.
So they are bleeding cash, just trying to build the physical capacity to meet the demand.
Right.
Now, the traditional way to survive that kind of burn rate is to just slowly scale up, right? Improve efficiency over time.
That's usually the playbook, yeah?
But Energy Fuels didn't do that. Instead, they announced a $1.9 billion acquisition of a company called VAC,
Right.
which is a major manufacturer of permanent magnets.
And this is the pivot that changed absolutely everything about how the market views them. It is this really aggressive mine-to-magnet strategy.
Okay, let's unpack this. Because taking a speculative mining company and suddenly buying a highly technical manufacturing firm, that is a massive leap.
It's huge.
It's like taking a company that mines raw silicon sand out of a quarry and suddenly having them buy a fabrication plant to manufacture quantum microchips.
That's actually a really good analogy.
Right. It is a completely different universe of technical expertise.
Right.
Moving from just extracting raw oxides to engineering highly sensitive permanent magnets. It's a colossal operational shift.
It is, and the complexity of that transition is a major source of friction for investors right now. But, we have to look at the geopolitical necessity driving the decision. Energy Fuels is attempting to secure a fully domestic supply chain.
Because right now, that supply chain is basically a straight line to Beijing, isn't it?
It is entirely dominated by China. I mean, from the processing of the rare earth elements all the way to the actual metallurgical engineering of the permanent magnets.
Wow.
Yeah, the global market is just deeply reliant on Chinese infrastructure.
So by vertically integrating, by bringing both the raw extraction and the complex manufacturing under one Western roof, Energy Fuels is attempting to build a protective moat.
Precisely. They are insulating themselves against the risk of, foreign export bans or broader geopolitical trade wars.
Okay, I understand the geopolitical theory. That makes total sense.
Yeah.
But let's look at the financial reality. Energy Fuels currently has a market cap of around $3.14 billion.
Right.
And they are trading at a price-to-sales ratio of 37.05.
Which is extremely high.
Just for context, for you listening, a mature, profitable mining company might trade at 2 or 3 times its sales.
Yeah.
37 times means investors are paying an absolutely massive premium based on the hope of future perfection.
That's spot on.
And add in the fact that they have that negative 82% net margin.
Yeah.
My question is this. Isn't a $1.9 billion acquisition a terrifying gamble when your balance sheet is already bleeding that much cash?
Oh, it is an incredibly leveraged bet. The balance sheet is definitely under immense pressure.
Yeah.
But what's fascinating here is that management is making this move right now because the macroeconomic tailwinds, specifically regarding global power and infrastructure, are just accelerating faster than anyone predicted.
We're talking about the AI boom, right?
We are. The energy and nuclear sectors are seeing this broad upward momentum directly tied to the power requirements of artificial intelligence.
And the rollout of all those hyperscale data centers.
Exactly.
Let's actually break down how those two things connect. Because I think a lot of people view AI as this sort of ethereal, cloud-based software.
Right, it feels invisible.
Yeah, like you ask a chatbot a question, and an answer just appears. But the physical reality of generating that answer requires a staggering amount of hardware.
It does. We are talking about warehouses packed with thousands of highly advanced GPUs running nonstop.
Right.
And those server farms generate immense heat.
Oh, yeah.
The cooling systems required to keep those data centers from literally melting down, they utilize advanced robotics, industrial pumps, high-efficiency motors.
And all of those physical components require high-performance permanent magnets.
Exactly. Which, of course, require the rare earth elements that Energy Fuels is mining and now planning to manufacture through VAC.
It's all connected.
Furthermore, those data centers require massive amounts of uninterrupted baseload electricity.
Because they run 20/47.
Right. And wind and solar are intermittent. They depend on weather conditions. You simply cannot run a hyperscale AI data center on intermittent power.
Which is driving a global nuclear energy renaissance.
Exactly. And nuclear energy requires uranium.
So if you trace the futuristic AI boom all the way back down the supply chain, it is completely reliant on pulling old-school uranium and rare earth minerals out of the dirt.
It really is.
If you don't have the physical rock, you simply don't get the artificial intelligence.
And that is the absolute foundation of the bullish thesis here. Western governments, major tech companies, they are rapidly waking up to this vulnerability.
Yeah, they have to.
So a vertically integrated company that holds a Western duopoly in these specific materials, it suddenly stops being just a speculative mining stock.
Right. It becomes critical geopolitical infrastructure.
Exactly.
Okay, so we have a company with accelerating revenue, a bold $1.9 billion vertical integration to secure the Western supply chain, and this AI data center boom driving a massive demand cycle for their exact product.
It sounds like a dream setup.
It does. If you look at that setup, it sounds like a stock that should be rocketing upward.
But as you mentioned at the start of our deep dive, the technical data paints a very grim picture.
All right, let's look at the damage. The stock is currently trading at $12.31.
Ouch.
Yeah, and back in January of 2026, it hit a high of $27.90.
That's a massive drop.
Over the last 13 weeks alone, the return is a brutal negative 39.73%. It is sitting precariously close to its 52-week low.
It's been hammered.
If they are building the foundation for the AI revolution, why is the market punishing them so severely right now?
Because the broader market is undergoing a ruthless reevaluation of risk.
Yeah.
particularly in the critical minerals sector. Investors are operating in an environment where capital is expensive.
Right. Interest rates, inflation.
Exactly. They are heavily rewarding established producers who are generating immediate positive free cash flow. And conversely, they are severely punishing developers who are operating at a loss.
Which brings us right back to that negative 82.7% net margin.
Exactly. The market isn't willing to fund the development phase anymore.
But tolerance for a story stock has just evaporated.
Pretty much. Energy Fuels is telling a highly compelling strategic story, sure. But their free cash flow is deeply negative because of the infrastructure development and the massive cost of absorbing VAC.
So the market is essentially saying, we agree with your geopolitical thesis, but we refuse to pay a 37 times price-to-sales premium while we wait for you to figure out how to manufacture magnets profitably.
Because that is a perfect summary.
Well, that makes logical sense. It definitely explains the 40% haircut.
It does.
But here's where it gets really interesting. When we look at the internal data, there is a counter-narrative forming that complicates things entirely.
Absolutely.
Because while the retail market and institutional investors are dumping the stock, the insiders, like the executives and board members who are actually running the company, they are aggressively accumulating shares.
The insider activity is honestly one of the most glaring data points we have right now.
Let me give you the numbers. Over the last 90 days, insiders at Energy Fuels purchased a net 95,730 shares on the open market, spread across 4 separate transactions. And the number of shares sold by insiders during that same 90-day window?
Let me guess.
0. A 100% buy ratio during a massive sell-off.
Yeah, what we're looking at here is a classic example of cluster buying.
Now, if you were listening to this, your immediate thought is probably, are these executives just trying to artificially prop up a failing stock to calm down retail investors?
Which happens.
It does. So let's look at why cluster buying is different than just, a single CEO making a token purchase.
Right, because a single executive buying shares can absolutely be a public relations move.
For sure.
But when multiple insiders people across different departments with varying levels of operational visibility all begin accumulating shares with their own money, it signals a shared internal conviction.
Right.
And it is happening during a period of very low trading volume, roughly 0.73 times the 3-month average.
Which is key. There's an old saying in finance, right? Insiders might sell a stock for a dozen different reasons.
Buying a house, paying taxes.
Exactly. Diversifying assets, whatever. But there is only one reason an insider buys their own stock on the open market. They believe the current price is a severe discount to its near-term value.
Spot on. Because they possess the most intimate, real-time knowledge of how this $1.9 billion integration with VAC is actually progressing behind closed doors.
They see the stuff we don't.
Exactly. They are the ones seeing the initial engineering reports. And most importantly, they are the ones negotiating the offtake agreements.
Okay, let's clarify that term for a second for the listeners. An offtake agreement is basically a contract where a major buyer, say an electric vehicle manufacturer or a defense contractor, they guarantee they will buy a certain amount of your permanent magnets in the future, right?
Yes.
Like before you've even finished building the factory.
Correct. It secures future revenue and entirely de-risks the operation.
Wow.
And the public market doesn't see those negotiations until the ink is dry. But the insiders, they see the pipeline.
So historically, this kind of heavy cluster buying during a quiet period often precedes a major structural bottom for a stock.
It does. It's a very strong signal.
The people steering the ship seem to believe the worst of the storm has passed. However, we cannot just blindly follow insider optimism.
Right.
The broader market slashed 40% off this valuation for a reason, and we really need to objectively weigh the bear case.
We do.
So what are the structural risks that could actually justify this sell-off over the next year?
Well, the primary vulnerability is execution risk regarding the VAC acquisition.
Which goes back to the complexity we talked about.
Exactly. We keep circling back to that negative 82.7% net margin because it provides absolutely zero safety net.
Yeah, there's no room for error.
None. If the integration of VAC is delayed by technical hurdles, or if the corporate cultures clash, or, if they struggle to calibrate the manufacturing equipment to meet Western standards, the cash burn will rapidly accelerate.
And that leads to the risk of multiple compression.
Yes, that is a massive risk.
For those unfamiliar with the term, multiple compression is basically a change in how the market labels you.
Right.
So right now, Energy Fuels enjoys that massive 37 times price to sales multiple because investors view them as this high-growth, tech-adjacent, critical materials play.
Yeah.
But if they stumble, the market will relabel them as just a struggling, over-leveraged mining company.
And if that happens, the market might decide they only deserve a multiple of 3 times sales instead of 37.
That's a scary thought.
Very. Even if their underlying revenue stays flat, the stock price would crater simply because the premium is wiped out.
That's a huge cliff to fall off of. The second major risk we need to look at is their exposure to commodity pricing,
Right.
because they're diversifying into finished magnets. But today, they are still fundamentally exposed to the cyclical prices of raw vanadium and uranium.
And the data shows that vanadium prices have recently fallen again in China.
Let me push back on how they navigate that, because to me, this seems like an existential threat.
It's definitely a major hurdle.
If Chinese vanadium prices keep dropping, doesn't that completely undermine the profitability of this newly integrated Western supply chain before it even gets fully operational?
It could, yeah.
I mean, if China decides to flood the global market with deeply subsidized, artificially cheap materials, how does a highly leveraged Western company with massive capital expenditures compete on price?
That is the exact mechanism of vulnerability the market is pricing in right now.
It makes sense.
A prolonged, intentional downturn in these commodities, driven by Chinese oversupply, would severely pressure Energy Fuels' top line.
Wow.
They are in a highly fragile transitional phase right now. I would estimate they are facing a 12 to 24-month window where they are dangerously exposed to macroeconomic commodity swings.
So they are attempting to build a fortress, but the walls are only half built.
Great way to phrase it. Until the VAC acquisition is fully operational and they are selling high-margin finished magnets locked into long-term contracts, they remain at the mercy of global pricing dynamics.
It is a race against the clock.
Literally.
Can they finish building the mine-to-magnet infrastructure and sign those long-term offtake agreements before a prolonged commodity slump dries up their remaining cash reserves?
That is the multi-billion-dollar question.
Yeah.
But when synthesizing the financial realities, the insider conviction, and the macro tailwinds, the consensus view from our sources points to a 7 out of 10 bullish confidence score.
A 7 out of 10. Okay.
Yeah. It is viewed as a high-conviction, multi-year turnaround play, but one that requires a serious stomach for intense short-term volatility.
So what does this all mean for you as you monitor this space? Energy Fuels is attempting one of the most difficult high-wire maneuvers in modern industry.
They really are.
They are trying to transform from a speculative, capital-burning raw materials miner into a fully integrated domestic powerhouse for critical tech materials.
It's ambitious.
Very. And if they pull it off, they are perfectly positioned to capitalize on a world that is suddenly desperate for domestic supply chains to feed the AI and nuclear energy boom.
Right. And the immediate data point you need to watch is their upcoming quarterly earnings report.
Good call.
Their last major shareholder call was June 24th, 2026. This next report will be the crucial barometer.
What exactly should listeners be looking for in that report?
You want to look for management providing concrete milestones on the VAC integration. Any announcement of new offtake agreements for their permanent magnets will serve as an immediate validating catalyst for the market.
That makes sense.
Additionally, keep an eye on macro policy. Any shifts by Western governments, whether through tariffs, subsidies, or domestic infrastructure spending, will directly alter the math for this company.
It is a fascinating pivot point, not just for a single stock, but for how the infrastructure of the next century is actually being built.
It really is, and it leaves us with a lingering thought to consider.
Let's hear it.
We spend so much of our time looking at the software of the future. We marvel at AI algorithms, advanced robotics, and global data networks.
Oh, constantly.
Right. We naturally assume that the power lies with the people writing the code. But if the global supply of the rare earth magnets and the nuclear fuel required to physically run that future becomes restricted, who really holds the keys to tomorrow?
Wow.
Is it the tech billionaires in Silicon Valley, or is it the companies out there controlling the dust and the rock that the entire virtual world is built upon?
You cannot run a digital future without the physical earth to sustain it. Thank you for joining us for this deep dive. Keep asking the hard questions, keep looking beneath the surface of the charts, and we will see you next time as we unpack another layer of how this incredible world actually works.